Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be analysing KONE stock. We'll be using TIKR terminal to go through the financials, and then I'll put the numbers into my DCF and we'll come to a fair value of their stock. Straight into it. So who are KONE? So KONE, officially stylized as KONE, so KONE Corporation is an international engineering and service company employing over 60,000 personnel across 60 countries worldwide. It was founded in 1910 and is headquartered in Espoo near Helsinki, Finland. So basically what does this company do? They make moving walkways and elevators / lifts if you're in the UK. And they provide servicing for the automatic doors, gates, escalators and lifts as well. So we've got a lot going on. Anything to do with elevators and escalators, etc., they are on it. Since 1924, KONE has been controlled by the Hurling family, one of Finland's wealthiest families. So it's interesting that they've got that family heritage with them as well. So the company itself is traded on the Nasdaq Helsinki, and I guess it's on the Finnish index. I don't know what it's called, but yeah, pretty big company. Now let's have a look at the sales for KONE and sales per business. So 2021, new equipment was 54%, services maintenance was 33%, services modernisation was 14% as well. So quite a spread of revenue across the new equipment and then the servicing. It's about 50-50, so that's quite cool to see. So new equipment managed to be new lifts, new elevators, and then servicing it is for the rest of the revenue. Quite a cool business model. So China makes up 35% of revenue, EMEA makes up 17%, US 15%, and you can go through the other countries yourself and have a look, but it's quite a worldwide company. Not just one region on the globe, quite spread out, but a lot of revenue in China, something to take note of. Now let's take a look at the financials for KONE, and let's use TIKR terminal as always. So income statement, in 2017 to 21, revenue has increased ever so slightly, probably about 10%, just over 10% whatever. So yeah, increased revenue slowly, let's just say that. Net income, pretty much flat to be totally honest. Can't really argue anything less apart from flat revenue, so you can't really predict much growth. Shares outstanding have gone up ever so slightly, pretty much flat though. Look at that, change year on year, not much. So we haven't really issued many shares, but we haven't bought back many shares. Cash and short-term investments are pretty much flat as well. Long-term debt, let's have a look at this one. So yeah, if it's not much debt at all, there's barely any long-term debt, which is awesome. You do find this with European companies, there's not much debt on the balance sheets. Return earnings, pretty flat, so not much going on. Cash flow statement then, let's have a look at cash flow from operations. But alright, this is where the growth is then. Free cash flow has increased by quite a bit, even if the profit hasn't. So capex is quite minimal, but they've managed to increase their cash flow from basically their free cash flow quite impressively. So that's a good sign. Let's have a look at the dividends. They do pay a dividend, love it. Special dividend as well in 21, so that's a cool thing. Special dividend is up to management discretion. I mean, all dividends are, while shareholders vote for dividends, while management decide as well. But a special dividend's good as well. Management decided to release some capital to the shareholders, which is a good sign. Ratios. So return on capital is very high. This is what's drawn me to this business actually, quite high capital. Return on capital, so in the mid to high 30s, or mid 30s, let's be honest. Last 12 months 42, so that's pretty cool. Net income margin very solid, about 9-10%, and free cash flow as well, relatively similar. Actually no, it's increased the past few years. It's at 11, 13, 12%, up from 2018 and 17, so which is pretty decent. Current ratio way above 1. Cash conversion cycle isn't below 60, but we can deal with that. Debt to capital, not much debt in the business at all, 14% debt to capital, which is sick. So yeah, if you like these ratios, if you like these financials on TIKR terminal, I've got my link in the description below. Sign up to TIKR terminal through that and let me know how you find the platform. I think for a tenner a month it's absolutely fantastic if you are analysing companies like myself on a weekly basis. Makes the process very smooth, very easy, get on it. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. So KONE are unfortunately not on Genuine Impact, as I usually do my Genuine Impact analysis, but you can research stocks in under 2 minutes on Genuine Impact, and we've got stocks in the US, most of Europe. With KONE being in Finland, quite an obscure company, so it's not quite on the platform yet, but if you'd like to use Genuine Impact, I've got my link in the description below. They've kindly sponsored this video, so head over there, aid your stock research process with Genuine Impact, and I'm sure you'll find it very, very useful. Now let's have a look at my analysis checklist for KONE, and we'll start with some basic figures. So 20 billion market cap, P/E ratio of 31, so quite high. So first pillar anyway, so profitability wise, so return on capital, so we've got 33% average 5 years, which is awesome. Gross profit, 5-year average of 53%, which is really good. Net margin and free cash flow don't quite meet the 10%, but they are very, very close, so that is very harsh, they're in the red. Very consistent, around 9 to 10% margins. If you're that consistent, you can't complain too much. I just have a bit of a threshold, I have to say, good or bad, but it's all subjective at the end of the day, isn't it? Current ratio above 1, which is class. CCC isn't below 60, can cope with that. Not much debt as well going on. Proven ability to grow, so it's all good growth apart from return earnings, which is down. Could be many reasons why. Paying dividends out but haven't made much profit, that could be a reason. Capital allocation wise, yeah, it makes this company look really bad, does this? So long-term debt repayment, there's not much debt in the business, so they've issued a little bit of debt and it gives them the red mark, but take it with a pinch of salt. Decreasing share count, they've issued ever so slightly some shares. Employee stock options most likely. Dividend growth has been there, which is good, and good acquisitions. Like I say, take that with a pinch of salt, it's probably just some asset write-offs. Quality score 53%, one of the worst I've done for companies I'm interested in, but it's why you should take these analysis processes with a pinch of salt. It's not black or white. For example, if they were green and these were green, it'd probably look like an 85% quality score stock, but it is what it is. Take it all with a pinch of salt. Apart from the valuation, you can't take that with a pinch of salt. Price to fair price, currently P/E ratio 23, price to free cash flow ratio 14. This is why I've got interest in it, because free cash flow is looking cheap. So 10% return, 36 euros, I believe it is. Yeah, it's euros, I'm right. So these fall 16% to get to my fair value. So let's have a look at my DCF. So I've used analyst estimates from marketscreener.com. Actually decreased free cash flow from 2021 and 2020. So these are quite conservative, I'd say. Going into the future, growth at a very simple rate, nothing crazy. 36 euros for this company. If it hits it, I'll be very happy. We'll have to see, but these metrics are very deceiving for this company. If they were green, these were green, you'd suddenly be thinking, bloody hell, this is a decent company. But yeah, take some of these figures with a pinch of salt, but then the valuation wise, it's slowly getting there. And I'd love to have this company in my portfolio. Add like European diversification. It's an industry which is always going to be growing as long as the world's urbanising. Lifts and elevators, escalators, it's all going to be very interesting. But yeah, if this company hits my fair value, I'll be definitely taking a closer look. I can't get my words out. But yeah, it needs to fall a bit. 16% needs to fall. We will see if it gets there. So there we have it. That was my full stock analysis for KONE. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.